Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have the CFO, Dom Kizek from Yangaroo, Inc. Yangaroo trades on the TSX Venture Exchange under the symbol YOO and on the OTC under YOOIF. The company is currently trading at 5.5 cents with roughly 62 million shares outstanding, or about a $3.5 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks a lot, Trevor. We were trying to figure out how long it's been since we've had somebody from Yangaroo talk to us, and we think it's about 2 years. So clearly we're due for an update. So Dom, thank you so much for joining us today. Dom, before we sort of get into the updates, why don't you remind us all what Yangaroo is all about, and then I'll just let you flow into your presentation however you want to.
Awesome. Thanks, Paul. Thanks, Trevor. Yangaroo is a cloud-based platform. Essentially, it's a workflow for digital asset management with 3 pillars. We have an award side of the business, music side of the business, and then finally our biggest is the advertising workflow.
Perfect. So yeah, you brought a presentation with you. Why don't you just
why don't I jump in and
onto it? You bet.
Perfect. So our mission is to be the platform of choice for the advertising, music, and award show businesses. We're primarily a B2B company, although we do have some direct-to-consumer exposure as well on the music side of the business. On the music side, we have it's our second biggest division, approximately $1.8 million in 2021. These are all US dollar figures. We, as of this year, we are a functional US dollar reporting company. 80% of our business on the music side is recurring revenue, so traditional SaaS, and then 20% is what we call PaaS, or platform as a service, so variable but still recurring customers. The advertising column that you see in the middle is our biggest division in the company. Approximately 2021 revenue was $6.4 million. Conversely, here in the advertising side of the business, 90% is PaaS. It's recurring, but it is variable customers. And then 10% is SaaS, or your traditional fixed recurring sales. Finally, on the word side, smallest of our 3 divisions, approximately $1.5 million in 2021, and 100% is SaaS, or fixed recurring long-term contracts. On the advertising side, what we do essentially is we're a media asset delivery platform. So advertisers use our platform, they log in, and they deliver their content to linear TV, connected TV, CTV, social, and digital destinations. They log in whenever they want. They pay a fee, variable fee, when they do log in and do deliver with us. And then on top of that, we have a whole bunch of services all in the platform, and as well manually done. The production services, clearance, watermarking, measurement, and dashboard information. Something new we're really investing this year is analytics. What we're essentially trying to do is provide audit-back information to the advertisers through analytic means of a dashboard. And we're seeing some pretty good traction there on this side of the business. So essentially, if you're a linear or digital or CTV advertiser, you want to see more bang for your buck, or ROI, you want to see how that's getting returned, this tool provides you the analytics and the audit capabilities for your ads. We also do some ad serving with a partner of ours called Innovid. In terms of our second biggest division, music, which was what the core of the company was founded on back in mid-2000s. Essentially the same technology platform, same architecture, but it serves the music division or music industries. Companies log in, consumers, big labels use our platform, our architecture to deliver their promotional music to traditional linear radio stations. And they do that, on a monthly recurring basis, but it also variable. And we do have a component that's fixed, and that's primarily with the big music labels. So some of the services that we provide is, as you can see here, delivery, metadata, watermarking, post-production services, and measurement as well. And then finally, on the award side of the business, essentially we are the back-end architecture for most of the biggest award shows, entertainment award shows in North America. So some of the big award shows that we have are the Tonys, the Emmys, the Junos, the Golden Globes. We pretty much power all of the big award shows except for the Oscars, using the same architecture and the same technology that powers our music and advertising divisions. Some of these features that we offer in the unique tool is a way to submit nominations, support services, voting and balloting, auditor collaboration, and then the confirmation of the award results. Overall strategy, look, we have a disciplined growth approach. We invest in our technology and our people. We have a goal of sustaining 50% annual organic growth, including, of course, any COVID-related volatility, which we saw over the past 2 years. And we have a proven business model. We focus on managing our cost, generating EBITDA, leveraging our balance sheet. We did a significant acquisition last year out of New York, and we had a term loan facility of about $2.8 million with the National Bank of Canada. And we also have a revolving loan facility in place with the National of about $1.5 million. Some highlights, 2020 adjusted EBITDA of $2 million, 2021 EBITDA of $0.8 million. We had the first pretty significant acquisition in corporate history last year in May of 2021. So our strategy really is, first fold is organic growth, is really going after customers in advertising and music. And then we will also look at acquisition strategies, so tuck-in opportunities with immediate revenue and cash flow generating impact. At the same time, we're always investing into our technology. So we have some pretty significant dollars going into our software development initiatives. And then we have strong banking relationships. So we have, like I mentioned, we have a $2.8 million term facility and then a $1.5 million revolver. Quick glance at our balance sheet structure, capital structure as of March 31st, cash of just under $1 million. We were a little bit underwater on our working capital because we were offside on our term loan facility, but we're happy to report that we're going to be in a position to amend that agreement and get back on side. So that working capital is going to flip over in Q3 or Q4. Like Paul said, we have 62 million in shares outstanding. Of course, we have some options and RSUs as well. And then in terms of the shareholder breakdown, we have some pretty big institutions, primarily out of New York, some big insider ownership as well on the management and board level. And then finally, we have some pretty big significant retail investors throughout a long public tenure. This is our executive team. Grant's primarily coming out of the advertising space. Rich Closa has been our CTO for a very long time and significant experience in building the architecture of our company. And then we have Adam Hunt, who's the SVP primarily of the music and awards divisions. 3 independent board members, all with significant holdings. And then we have our CEO, Grant, on the board as well. And that is it.
Perfect. We appreciate that. Thank you so much. Let me just dive into a couple things here. The change in CEO. When we start off with that, when did it happen, and what can you tell us about the new CEO and then sort of the expectations for him?
So it's going to be about approximately 24 months as of November, so 2 years into Grant's tenure as CEO. Grant Schutrump, he was our president of our advertising division prior to that. So he's been with the company for just over 5 years now. Really, the change was to align ourselves with the division that had the highest growth and the highest revenue potential that we saw at that point in time. So back in November of 2020, we made some significant changes to the board as well as changes to the CEO. And that really put us on a trajectory of growth. Last year, on the back of the new CEO, we had a significant acquisition in New York, which really doubled our advertising revenue in that division. We're also looking at other tuck-in and organic opportunities going forward, but really the focus was the advertising space, the ad tech component of our company, as we feel that's really where the highest addressable market is and the highest potential for Yangaroo.
So yeah, that sort of leads into my other question is of the sort of the three divisions you have, I assume that the advertising is where you're going to focus the most sort of resources. I would expect it's probably got the biggest, total addressable market, but maybe explain that. Am I wrong or am I right?
Paul, you're absolutely right. That's right. On the radio and the word side, we do not see a significant growth potential outside of Canada and the United States. However, on the advertising side, we're a small fish in a really big, significant sea. Some of our biggest competitors, for example, Extreme Reach, they're probably 10 times big in terms of annual overhead or annual sales. And we really are the third biggest player in that industry. So we see a lot of significant growth potential, both just from acquiring books of businesses, but also developing the technology and organically acquiring those customers.
Mm-hmm. Maybe explain a little bit more sort of granularly what on the advertising side, what do you do? Now I know you sort of package media up and you deliver it sort of in a secure fashion. You're able to measure how many times it's broadcast or how many times it's used. Maybe give us a little bit more detail around the
yeah, no problem. So traditionally, consumer brands would, if, for example, you're General Motors, and you want to put your 30-second spot on Monday Night Football, as an example. Traditionally, back in the day, you would have to send a CD, DVD, or maybe VHS tape back in the day, or potentially log into some kind of server on the broadcaster side and physically upload that file and make sure that it's communicated, the file's up, and you're able to air it. So our platform does all those services in an automated fashion. That same advertiser would log into our platform. They would upload the spot. They would click when and where they want to have it delivered to. So if they want to have it delivered to ESPN Monday Night Football, let's say September 19th, our software would actually physically verify the delivery of that ad into the server. And then on top of that, we have other white glove services. So we can do quality control, quality assurance of that spot. We can do post-production services, for example, closed captioning. And then there's other components that we're trying to introduce, which we're rolling out pretty successfully. The analytics data, which is the post-delivery items.
Gotcha. Now I saw that the advertising revenue is actually lower this quarter over the same period last year. Maybe give us a sense of the state of the industry, or more specifically, what was the cause of the drop in revenues?
Absolutely, Paul. What we've seen, especially early this year in January and February of this year, is we saw a pretty significant drop off in volumes on the advertising front. And what we found out through discussing with our customers, discussing with competitors and industry, is that this is a result of a consumer brand, essentially recessionary spend in marketing dollars. What we think is this is primarily attributed to is number one, it was a supply chain crunch. So past 2 years, as inventories were going down, a lot of the consumer brands with inventories just had nothing to sell. So they had nothing to sell in store. If you're a GM or a Toyota and you have nothing to sell, you're not going to heavily market those products. So that was number one. And then number two, we think it was macroeconomic effects. We think a lot of companies were foreshadowing a recessionary impact. And of course, when that happens, the first thing they cut is their marketing budgets. So I like to say that we were kind of a canary in the coal mine. We were the first to feel those recessionary impacts to the marketing spends. Now, we have seen that bottom out as of Q2 into Q3, the summer months. So we think that bottom has hit, and we are forecasting an increase back to kind of pre-recessionary spend dollars. And then, Finally, just want to point out that we had suffered no customer losses. This is all primarily volume. And then all of our competitors also had the same impact in terms of dollar drop-off. So it was more of a volume issue rather than a customer loss issue.
Yeah, understood. Why don't we touch on one other thing, the breach of covenant on the debt. Maybe give us an update there and how you see that resolving itself.
Yeah, look, our senior lender is really a great partner with us. They really helped us out with securing the acquisition last year. And it really ties into what we were just mentioning in terms of our advertising dollar drop-off. Our covenants we became offset on our covenants as a result of the significant volume drop-off in advertising. Now, we've addressed that. We've had a pretty big significant restructuring in Q1 and Q2. As an example, we went from just under 100 headcount to just over 60 as of today. So we've saved some significant dollars on our G&A and in our labor costs. And we're also seeing a bottom off, and if not a small gradual increase in our volume. So look, our financial partners, our bank has seen that. They want to work with us and have indicated that they're willing to amend this agreement. And we're hopeful that we can announce something over the next month, if not prior to quarter end.
Perfect. And just other challenges you guys are facing. What else can you tell us? Sort of what keeps you up at night? I know you're the CFO, so it's probably more financial related. But just in general, what kind of challenges does the business face that we haven't addressed here?
One of our biggest challenges is software development costs. As everybody may know, engineer and software people have really, their salaries have really skyrocketed. So for us, keeping quality staff and making sure our bottom line is healthy is a challenge. Certain ways that we do that is, number one, we're primarily, at least our software development team is primarily based out of Toronto, where we think salaries and costs are still relatively low, especially compared to the US. So we have that competitive advantage where we secure good talent at a below market rate, being based out of Toronto. And then we focus our sales and marketing and business development strategies into the US. So that definitely helps on the cost side of the equation. Macroeconomics, of course, is concerns us all always, right? The interest rate environment, what impact that will have on our customers and our consumers. That's kind of how we think about the day to day. And how we address that is just being very conservative. So we have, internally we develop very conservative financials, forecasted revenue, and we model our costs, around those very conservative forecasts. So we're very conservative in terms of trying to generate EBITDA on a quarterly basis, and we're trying to get to that goal by end of Q4 this year into 2023.
Looking forward, what sort of new products or services or new initiatives? What are you excited about? Like what does this look like going forward?
We're investing heavily into analytics. We believe data and being able to drive that data back into our consumers is really what's going to drive value for us. We feel like our core advertising business, the delivery side of the business, is essentially commoditized at this point. There's three primary tech companies that do what we do, but it's from a competitor perspective, we feel like the differentiator will really be the analytics portion. So we're heavily involved on the analytics side, and we've been pushing some significant investment into that, and we're seeing some very promising early results, and consumer brands and customers that are really liking the product.
Mm-hmm. I got a question that came in from one of the viewers here. I'll just ask it right off here. Could you please speak to if you were able to achieve organic growth in the digital media services since acquisition?
We've in terms of the DMS acquisition, so the answer would be no. Our volumes in advertising have dropped off across the entire advertising sphere. So in terms of acquiring customers, new customers, yes. Unfortunately, on the aggregate, when you include volumes, our dollars have just dropped off across the board in terms of the advertising space. And we're seeing that across the entire industry and our competitors. So the answer is kind of yes and no. We have acquired new customers organically, but unfortunately, across the board, volumes have dropped off primarily due to those macroeconomic reasons.
Mm-hmm. Now, earlier you touched on, you've made an acquisition, you're looking at other acquisitions, but can you give us more specifics around sort of where you want to take this? Is this a technology sort of acquisition you're looking for? Is it more really trying to buy customers, relationships? What can you tell us?
On a future basis or the historic?
Sure, yeah, future, looking forward, yeah.
Yeah, look, we're opportunistic. We feel that there's opportunities, especially in this market with a lot of companies struggling, where we can acquire customer books or books of customers for a cheap basis. Mm-hmm. And on the other hand, we feel like if there's a good opportunity to acquire technology at the right price, absolutely. So really, it's a case-by-case basis, and it's based on the right valuation, and of course, based on our financial position as well.
Now, as investors, what do you think are they call it the catalysts or milestones that we should be paying attention to, or even sort of internal metrics? Revenue is always easy. If the revenue is going up, then we know something's going on. But is there anything else we should be watching for to determine how well you guys are progressing?
Yeah. So internally and externally, what we really focus on is our adjusted EBITDA and our adjusted EBITDA percentage margins. We really like to maintain a healthy EBITDA margin on a go-forward basis. We're also looking to introduce new KPIs. So internally, we do look at volumes of usage in our platform, and that's something that we want to introduce to the market. And I feel like we'll be in a position to do that in 2023.
Fantastic. And just last, sort of not even a question, but what do you want to make sure everybody walks away with today? What's the key message that you want all these investors or potential investors to know about the business right now?
I think, as a valuation kind of guy, I think we're tremendously undervalued. 5.5 cents with our debt. I think our EV, we're trading at 1 times annualized revenue. We went through a pretty tough first half of 2022, but we feel like we've bottomed out, and we'll be able to really significantly improve on those financials coming into second half of 2022 and into 2023. So look, we went through a pretty significant transition last year with our first ever acquisition. We're really maturing as a corporate entity, and I feel like this was a big milestone last year. Unfortunately, some of the macro events that are really happening in the world did not go in our favor, but I feel like we feel as a management team that it'll improve significantly into 2023.
Fantastic. Well, it was 2 years since we last spoke with you guys. Hopefully we don't have to wait another 2 years to get caught up again. But Dom, really want to thank you for joining us. We've been speaking to Dom Kizek, CFO of Yangaroo, symbols YOO on the Venture Exchange. If you got any other questions that we kind of missed here, feel free to let us know, or you can contact the company directly. Dom, what's the best way somebody can reach you guys?
Really, it's my email. If anybody looks on our press releases, my email and name's at the bottom. It's dom.kizek@yangaroo.com.
Perfect. Well, I appreciate it. Thanks, Dom, for joining us today, and hope to catch up with you guys soon.
Thanks, Paul. Thanks, Trevor, and thanks, everybody.